I was on another coaching call this week and had a great question that I wanted to basically share with you guys. And the question was, how do high interest rates affect commercial real estate? So, for those of you who are newer to real estate or have heard it before, the value of commercial real estate, so commercial real estate in terms of apartment complexes, is 5 or more units, right? So, 5 plus units is commercial real estate, 1 to 4 units is residential real estate, right? By definition. So, for 5 plus units, the value of these assets, it's based on the net operating income divided by the market cap rate, right? So the net operating income is the income minus the expense on an annual basis, and then whatever is left over is a net operating income, and you want to divide that by the market cap rate. And the market cap rate is determined by the market, and it's affected by interest rates as well, which I'll dive into later. But in a simple example, let's just say I have a net operating income. Let's say my income is $200,000, my expense is $100,000, which is 50%. So that means that my net operating income is $100,000. So now I have the numerator of my equation, right? And let's just say the market cap rate is a 10 cap, right, for simplicity. So you're going to take $100,000, divide it by 10%, and then basically now your value of that asset is $1 million, right? So pretty easy, makes sense, right? So it's just basic math. So as you can see, as you increase your net operating income and the cap rate stays the same, so if my net operating income is now $120,000, divide that by the 10 cap, it's now worth 1.2 million. So as you increase your income and you decrease your expense over time, your net operating income goes up and then your value goes up, right? So that's why I love commercial real estate, because you can control the value, right? If you're a good operator, you increase your rents, you decrease your expense, NOI goes up, value goes up. If you're a bad operator, income goes down, expenses go up, NOI goes down, your value goes down, right? So, versus in residential real estate, which is 1 to 4 units, the value, it's based on the sales comps. So they don't care how much income you get. They just care, what does your neighbor's house sells for? If your neighbor house sells for $1 million and you're right next door, same square footage, yours will sell for $1 million as well. They don't care how much rent your unit gets and your neighbor's unit gets. You may get $10,000 a month and your neighbor gets $1 a month. They don't care. The value is based on sales comps, right? So that's the key distinction. So now let's talk about how interest rates will affect your cap rates. And if you look at the equation, it's going to affect the value, right? So for example, in Oklahoma, it's historically a 8 cap market, for example, right? But if interest rates are 8% now, like to today, then it doesn't make sense to the lender, right? Because they want to make sure that the asset's cash flowing. So what happens is when interest rates go up, the cap rates will expand or go up, right? So if, let's just say at 4% interest rates, the cap rate was 8 cap, right? That's at 4%. But now that the interest rates are 8%, the cap rate's not going to stay at 8%. It's going to go up to, let's just say, 10%, right? So let's just say before, same example, your net operating income was $100,000, right? And if you were at an 8 cap, you would take $100,000 divided by 8%, right? So the value is going to be higher versus if the cap rate went up from 8 to 10, now you're doing $100,000 NOI divided by a 10 cap, right? So in that case, your value go down. So as interest rates go up, cap rates go up, your value will go down, right? So that's what I experienced during my cash out refinance, because I thought it was going to be an 8 cap market, but that was assuming interest rates are about 4 to 5%. But now that interest rates are 8%, my cap rate went from 8% to 10%, and my value went down. So during the cash out refinance, since the value went down and I'm pulling out 75% or 70% loan to value, that my new loan's going to be less, so the money I pull out is less, right? So if you understand that at a high level, that's the main difference and distinction between commercial real estate and residential real estate, right? Really dumbed down and high level, right? So that's why I say if you're owning a 4-plex right now, just increase it to a 5-plex, and now your commercial loans, the value is based on the net operating income divided by the market cap rate. So, that's kind of how I understand it. And I thought it was a great question, and I've answered this multiple times, but I wanted to make it like very clear, right? So let's do it vice versa. So if interest rates go down again from 8%, let's say back down to 4%, and then what's that gonna do to my cap rate? It's gonna lower my cap rate, right? And if I lower my cap rate, NOI stays the same, my value will go up, right? So this is how everything is interconnected, right? So when interest rates are lower, cap rates are lower, values are up. Interest rates go higher, cap rates are higher, values go down. So hopefully this makes sense to you. Send this to somebody who's interested in getting into multifamily real estate. If you're interested in joining my coaching program, my mentorship program, check out the links down below. Love adding value to people and teaching people and helping get their first multifamily deal. And I hope to see you in the next one. Thank you so much.